Hello, everyone. This is Ron Corser with Cornerstone Retirement Partners. Welcome to our program today. We're going to have a really interesting time to talk. But here's a question I want to ask everybody. How do you go forward in the future to control how much you pay in tax and how much money you keep in all your life savings programs, your 401k, IRAs? How do you do that? It's today's program. That's what we're going to talk about. Is how do you minimize the amount of tax you're going to pay over your lifetime in all of these tax deferred accounts that you have. I'm Ron Corser with Cornerstone Retirement Partners. I want to welcome everybody to today's program. I think it'll be a very interesting one. Take some notes. Today's program will also be on our website, www.cornerstone-rp.com. That's www.cornerstone-rp.com. You can go there for today's program and all the other programs we've got there. There's a lot of great information because we do live in some troubling times and some interesting times. So the more information you have, the better chance you have of making really good decisions for your family. So what's the answer to how do we minimize the amount of tax we pay over our lifetime as we approach retirement? We've done all this savings. A lot of it is done on a tax deferred basis. That's what we're going to talk about today. It's called a Roth IRA. My goodness, what are we going to do about that? So let's talk about a Roth IRA, what it is, but more importantly, let's talk about why it may be important for you to work with an advisor who can help you over time minimize the amount of tax you're going to pay on all your life savings. So let's think about this. Just recently, our president announced a whole new budget with all kinds of different proposals in it. But the big one was really interesting, wasn't it? For those of us who kind of looked at it. He's going to spend more money. And this is not a political statement. It's just what they said. But they're going to raise taxes dramatically. And if the bill passes, it's going to impact everyone, even though it's been said, well, if you make less than $400,000 a year, it's not going to impact you. Here's what I just want to say. We think about where all the big money is when it comes to life savings. I've been told that there's probably 25 trillion or more in IRA accounts, 401ks, 403bs, 457s, SEP IRAs, all those retirement accounts. So think about this. We have basically what, a $32 trillion deficit? There's some great political math there. If we could just get our hands on that money and tax it, we could just really do great things for the deficit. But we know, in fact, what the government always does and what politicians do is they just spend more money. I mean, that's just the way the world is. So it's on us really to figure out how do we legally minimize the amount of tax you'll have to pay over your lifetime with all your hard-earned life savings. So stay tuned because we're going to get into what a Roth IRA does, but more importantly, how easy it is at times to do this. So let's take a look at it. All of us are familiar with IRA accounts. You put money into it, and if you have wages, you get a tax deduction. So with IRAs, whether it's a Roth or an IRA, you can, if you're over 50, you can put in 8,000. If you're under 50, you can put 7,000 this year. Everybody likes to get the tax deduction. But here's what happens. If you're over 50 and you put $8,000 into an IRA account, you don't get an $8,000 tax deduction. You only get the deduction based on whatever your tax rate is. So if you're paying 20% tax, federal, state, local, and everything, you put $8,000 in, you save about $1,600 in tax. That's not a small amount of money. But let me ask you this. What if 5 or 10 years from now, your tax rate goes from 20% to 21%? Not a big deal, right? So they gave you a tax break of 20% going in. Now they're going to charge you 21% taking it out. So even that small amount, let me ask you this question. Is that a good deal? I save 20% going in, but to take it out, I got to save 20, it costs 21%. Now, a lot of people think taxes are going to go up even more dramatically. So what if I'm paying 20% to put money in, I'm saving it, but down the road, it's going to be a 30% tax bite. All of a sudden, saving on a tax-deferred basis becomes a giant tax bill and a headache for all of us. So what's a solution? One is very simple. Work with an advisor who understands the IRA rules, but also the Roth IRA rules. In our company, Cornerstone Retirement Partners, we focus on a Roth strategy, so to speak, because that's how you have to do it. It's not something you just do once and let alone. Because over a period of time, you can try to maximize how much money you keep after tax using a Roth strategy. So I'm Ron Corsa with Cornerstone Retirement Partners. Give us a call at 616-301-2581. If what I'm talking about makes some sense and you have an interest in it, or go to our website, www.cornerstone-rp.com. Put your information in there. We'll reach out to you, get you the information you need, make really good decisions for yourself. So let's talk about a Roth. Number one, why would you want to do a Roth? What's the good news? Well, the more money you can put into a Roth IRA down the road, because when you take money out of a Roth, if you just follow a few simple rules, you never pay tax on that money. What's the downside to a Roth? Well, you give up the tax deduction because the money you put into a Roth is after-tax money. Whether you do it on your own in a Roth IRA or in a 401k Roth, you're putting in after-tax money, you're giving up a tax deduction. Most people really have a tough time doing that. That's why it's so important to take a long view on this. So let's say today your real tax rate is 15%. And when you retire in 5 years from now, 10 years from now, because taxes will go up, that's not something we should overlook. They will go up. They have to go up. We're going to pay more to take money out of these tax deferred accounts. So right now, particularly over the next 2 years, we have the lowest tax rate we're probably going to have for the rest of our life. The tax rules that were passed in 2017 go away at the end of 2025. They revert back to where they were in 2016. What does that mean for you? That means if you have a 10% federal tax rate, it's probably going to go to 15. If you have a 15, it's probably going to go to 21 or 25. Taxes are going to go automatically up, even if the government folks don't do a single thing, because this tax bill will sunset and it'll go all the way back to where it was in 2016. So even if nothing changes, our taxes are going to go up. So how do we deal with this? I go back to a long time ago, and I'm old enough to remember, there used to be a Fram oil filter. And this guy would take that oil filter and he'd slam it on the counter. And he'd say, you're going to pay me now or you're going to pay me later. What was he talking about? Well, at that time, the Fram oil filter was about $3. If you didn't want to change your oil and didn't want to get a new filter, you didn't have to. But at some point in time, your engine's going to blow up and it's going to cost you $1,000 to fix it. That's the mentality you have to have when you're thinking about creating a Roth IRA strategy for yourself. You should look at the government, look them right in the eye and say, I'm going to pay you now so I don't have to pay you later. And the government's going to say, fine, they like the tax money. But you're going to create a stream of income. If you work with an advisory firm like us, we do this all the time with clients because we do taxes, we do all of this other investment planning and income planning. We can tell you, for example, if you want to make a Roth conversion, meaning I want to take some money from my IRA and move it into a Roth IRA, what's going to happen to my taxes? We can do a Roth conversion strategy and show you the impact on your tax returns because we do that at our firm. It's one of the things we find very helpful for our clients. So you need to find out two things. Number one, if you convert 7,000 in a Roth conversion, how much extra is that going to cost you in taxes? Because remember, you're taking money out of your IRA. That's a taxable event, and you're moving it into a Roth IRA. So there's a tax bill involved. Or you may say, I have the ability to put in $7,000 if I'm under 50 or $8,000 if I'm over 50 into a 2024 tax program. I can deposit it. What are you giving up? If you do the Roth, you're giving up the tax deduction. What are you getting in return? You're creating the beginning of a stream of tax-free income that, if you manage it properly, will last for decades. So why would you want to do a Roth? Because number one, you think taxes, what you pay in tax is going to go up some point in time, and perhaps dramatically. What's the second reason? Number two, if you're thinking about leaving a legacy for your family, there's no better account you can leave for your kids or grandkids than a tax-free Roth IRA account. Number three, if you have both tax-free money in a Roth and tax-deferred money in a Roth, you can manage your tax bill a lot easier. Here's an example. You got $50,000 in a Roth and $500,000 in an IRA. And you need to put a new roof on your house. And you got $5,000 in a checking account. Well, how are you going to, maybe the new roof costs $20,000. So you can take it out of your IRA and you're going to pay tax on it. Or you can take it out of your Roth and never pay tax on it, which is going to be better. You might say, well, I don't want to pay any tax. That's probably true, but you need to see what that's going to do on your tax return, whether you take it out of an IRA that's tax deferred or out of a Roth. A lot of people we have as clients, when we've created a Roth strategy for them, they find that they can control their tax bill year in, year out by taking money from Roth, taking money from IRA, managing their tax bill so that they pay the minimum amount of tax each year over time, doing it all legally. So some people say, well, that makes great sense, Ron, but how do we go about doing that? Well, we can help you do that. Give me a call here at Cornerstone Retirement Partners, 616-301-2581. 616-301-2581. I'm Ron Corser with Cornerstone Retirement Partners. So how do we help you? Here's the first step we do. Number one, we come in and we ask a lot of questions, because it has to be that a Roth strategy is important to you, and that we both understand the tax implication that could be created by a Roth strategy going down the road, next 3, 5, 10 years. So that's the first thing we do. Second thing we do is we run a pro forma, or what I call a pretend tax return for you. And we say, well, if we take, we're going to do a conversion here now. Let's say if we take 10,000 or 20,000 or 50,000 out of our IRA, how does that impact our taxes for this year? Because that's really an important consideration. Well, we can show you that because we do taxes for our firm, for our clients. So we can show you in black and white what the tax implication is. Then you have to say, number three, what do I want to do with this money? And it may be nothing more than you just want to give it away to your children or grandchildren when you pass away, or you want to make gifts, or it may be that with our help, each year when it comes down to, if you're already over 73, for example, and you have to take out IRAs, how do we manage that tax bill? So having a Roth strategy, having it funded, meaning you're putting money into it over time in the most tax advantaged manner, paying the minimum amount of tax to put the maximum amount of money into a tax-free account, can create incredible freedom for you down the road, because the tax bill and the tax man is coming. And remember, the IRS is the one who always writes the rules on your IRA. People think that's an individual retirement account. A lot of people think an IRA is an individual retirement account for the IRS. And that's probably more true than we like to think. So a Roth strategy can be really important. There's a lot of do's and don'ts. We can help you with this. If it's important to you, not only control your taxes going forward, but to manage them and to minimize them, give us a call here at Cornerstone Retirement Partners, 616-301-2581, 616-301-2581. Go to our website, www.cornerstone-rp.com. Put your information in there. We'll reach out to you and help you in every which way you can. So if you have questions, call us. Look forward to hearing from you. Thanks a lot. Good day today.
Tune into Cornerstone Retirement Partners' full radio program, Your Course to Retirement, Sunday mornings at 9 o'clock at News Radio WOOD, or visit cornerstone-rp.com for many valuable resources, including those mentioned on this show and other great episodes of Your Course to Retirement.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor.
Ed Slott's Elite IRA Advisor Group is solely an indication that the financial advisor has attended training provided by Ed Slott and Company, passed biannual examinations on material covered at conferences and in webinars, and met other membership requirements, and does not constitute an endorsement of any kind. Ed Slott's Elite IRA Advisor Group members pay a fee for the educational programs that allow them to be included in the Ed Slott's Elite IRA Advisor Group. Membership does not guarantee investment success. Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services.
Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Annuity guarantees are based solely on the financial strength and claims paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.